Most traders spend far too much time trying to predict what happens next. Will the trade work? Will the market bounce? Is this breakout real? Is the dollar about to drop? And that sounds logical on the surface, but it's actually the wrong obsession, because profitable trading is not really about predicting individual outcomes. It's about building a process with a positive edge and applying it consistently over the long term. And one of the best ways to understand that is through two simple examples: a coin toss and a roulette wheel. So let's start with the coin toss. Imagine we play a simple game. We flip a coin, and if it lands on heads, you make $1. If it lands on tails, you lose $1. At that point, there's no edge. The odds are 50-50, and the payoff is symmetrical. So over time, neither side should expect to make any money. Now let's tweak one thing slightly. You still make $1 on heads, but on tails, instead of losing $1, you lose 90 cents. Now suddenly the game's changed. The coin is still fair, and the probability is still 50-50, but the payoff is no longer equal, and that tiny change gives a positive expectancy. So on average, each flip is now worth 5 cents to you, not because you can predict the next flip, not because you know something magical about the coin, but because the structure of the game shifted slightly in your favor. And this is exactly what an edge is. An edge is not certainty. It's not a prediction. It's not about being right all of the time. An edge is simply a setup where over a large enough sample size, the average outcome is positive. That's it. And once you understand that, you start seeing trading completely differently. Because a lot of traders think their job is predicting the next outcome, but that's not really the job. The job is to build a process where your average winner, your average loser, your average win rate, and your position sizing combine to give you a positive expected value over time. That's why two traders can take very different paths but both be very profitable. One trader might win often but keep the payoff on winners relatively small. Another trader might only be right 35 or 40% of the time, but when they're right, they make much more than they lose when they're wrong. A different style, but the same underlying principle: positive expectancy. Now here's the part most traders struggle with. You can have a real edge and still lose money in the short term. This is where people get themselves into trouble. If we go back to the coin toss game, even with a positive expectancy, there's nothing stopping you from getting a bad run early on. You could lose 5 flips in a row, 10, even more, but that doesn't mean that edges disappeared. It just means in the short term, outcomes are noisy. This is one of the hardest things for newer traders to accept. They think a losing streak means that the strategy is broken. They think that a winning streak means that they found the holy grail. Usually it means neither. It just means that they're looking at too small a sample size. And this is where the law of large numbers really matters. If you repeat a game with positive expectancy enough times, your results should start to converge towards that expectancy. Not in a single straight line, not without drawdowns, not without frustration. But over time, the maths will start to show through. And this is exactly how casinos think. And roulette is another brilliant example. When you walk up to a roulette table and you bet on black, it feels almost fair. There's 18 black numbers, 18 red numbers, and then there's the green zero. But that green zero is where the entire business model lives. It gives the house a small edge, just a slight tilt, nothing dramatic. But they don't need dramatic, they need repeatable. The casino does not know what happens on the next spin. They don't need to know. They're not trying to predict every result. What they're doing is running a game where the structure gives them a positive expectancy over a huge number of trials. This is why casinos don't panic when someone wins. This is why they don't start rewriting the rules after a bad hour. And this is why they can sit through short-term noise without losing confidence in the model. Because they understand something most traders don't. If you have an edge and you manage risk properly and you keep playing the same game long enough, the edge has a chance to work. And that's the lesson. Be the casino, not the gambler. And what does that mean in practical trading terms? It means stop treating each trade like it needs to prove your intelligence, and stop trying to emotionally predict every single move, and stop abandoning a system just because it went through a rough patch. Instead, think of it in terms of a process, in terms of probabilities. Do I have a tested idea? Do I have a sensible risk management framework? Am I keeping losses contained? Am I allowing winners to do enough work? And am I taking enough trades for the edge to actually express itself? And that's how I think about my own investing. Whether it's momentum, mean reversion, or trend following, I'm not asking, will this next trade definitely win? I'm asking, does the system have a positive expectancy over time? And am I executing it consistently enough for that expectancy to matter? That is a more useful question, because prediction can be seductive, but expectancy is what pays. And if you take nothing else from this video, take this. A good trader is not someone who always knows what's going to happen next. A good trader is someone who understands their edge, accepts short-term uncertainty, controls risks, and keeps applying a profitable game long enough for the maths to do its job. And that's how professionals really think. That's how casinos think. And in my view, that's how traders should think also.